Looking to build long-term wealth and passive income in the U.S. stock market? In this video, I break down 5 of the safest, strongest, and most undervalued U.S. stocks you should consider buying right now in June 2025. Whether you're a beginner or an experienced investor, these companies offer strong fundamentals, long-term growth potential, consistent dividend payouts, and high analyst confidence. What you'll learn in this video: which 5 U.S. companies are fundamentally strong and worth holding for the next decade. Full analysis including market cap, stock price, dividend yield, 3-year performance, and more. Real-time insights on each stock's key growth drivers, analyst sentiment, and whether it's a good long-term buy. How these stocks have outperformed the market historically, and what their future outlook looks like. We'll cover each company with deep insights, from their core business model to dividend stability, from stock valuation metrics to market. If you find this valuable, don't forget to like, comment, and subscribe for weekly videos on U.S. stock picks, dividends, and long-term investing. Hit the bell icon so you never miss a profitable update. First is Johnson & Johnson J&J. Company introduction. You might picture flashy tech giants when thinking of top U.S. stocks, but Johnson & Johnson proves that consistency beats hype. With a legacy dating back to 1886, Johnson & Johnson is a fortress in the global healthcare space, combining pharmaceuticals, medtech innovation, and reliable shareholder returns. Market cap, $373.45 billion USD. Current stock price, $155 and 21 cents. Dividend yield, 3.35%. 3-year price growth, -1.85%, including dividends. What sets Johnson & Johnson apart? It's one of the elite dividend kings, having raised its dividend for 61 straight years. While it doesn't offer high growth volatility, it rewards patient investors with stable, growing passive income. Its average dividend yield over the past 3 years sits between 2.8% and 3.2%, making it a reliable pick for income-focused investors. The company's 2023 spin-off of Kenvue allowed it to zero in on high-margin pharmaceutical and medtech segments. That shift is already showing results. J&J's pharmaceutical unit is leading in immunology and oncology, while the medical device division is innovating in robotic surgery and orthopedics. Growth is driven by an aging global population, healthcare demand in emerging markets, and billions invested annually into R&D. Johnson & Johnson also maintains a strong balance sheet, low debt-to-equity ratio, and powerful global brand recognition. Analyst sentiment. Wall Street remains confident. J.P. Morgan, Morningstar, and Goldman Sachs all rated as a buy or outperform, citing its recession-resistant revenue, robust pipeline, and shareholder-first strategy. Final verdict. Johnson & Johnson may not spike your portfolio overnight, but it's built to preserve and grow wealth over decades. For long-term investors seeking safety, yield, and durability, Johnson & Johnson is a must-have dividend anchor, one that can outlive downturns and still pay you every single quarter. Second, Microsoft Corporation, MSFD. Company introduction. You might not think of tech when you hear forever dividend stocks, but Microsoft changes the game. This $3 trillion software juggernaut isn't just a leader in cloud computing, AI, and enterprise software. It's also a reliable income-generating machine. Market cap, $3.42 trillion. Current stock price, $460.36. Dividend yield, 0.72%, modest but growing. 3-year dividend yield average, 0.82%. 3-year price growth, plus 73.63%. Microsoft has increased its dividend for 20 consecutive years, and while the yield is modest, its dividend growth rate is around 10% annually. That's what makes it a future dividend powerhouse. Over the last 3 years, Microsoft has seen its stock nearly double, fueled by relentless cloud growth via Azure, massive enterprise software revenue from Office 365, and now explosive momentum in AI infrastructure. Its operating margins remain strong at over 40%, and its $140+ billion in cash reserves give it room to buy back shares, invest in AI, and continue rewarding shareholders. The acquisition of Activision Blizzard and investments in OpenAI also position for dominance in gaming and AI ecosystems. Analyst sentiment. Nearly every major research firm, including Morgan Stanley and Wedbush, has Microsoft as a strong buy. They cite its consistent earnings beats, robust free cash flow, and durable long-term moat. Final verdict. Microsoft is the definition of a compounder. Even with a sub 1% yield, offers investors long-term capital appreciation and growing dividend income in one of the safest tech plays on the planet. Great, because the next stock we're about to reveal has a 4.33% dividend yield, an incredible 3-year price recovery, and is a favorite among value investors. Make sure to like, subscribe, and hit the bell, because every stock coming up now is a cash flow machine built for compounding wealth. And number 5 is one Wall Street continues to underestimate. Let's get to it. Company introduction. In a world of economic uncertainty, PepsiCo delivers rock-solid returns through its globally loved brands, sticky pricing power, and strong dividend history. From Pepsi and Gatorade to Lay's and Quaker, it's a cash-generating beast in both beverages and snacks. Market cap, $180.23 billion. Current stock price, $131.45. Dividend yield, 4.33%. 3-year dividend yield average, 3.17%. 3-year price growth, plus 28% fluctuating. PepsiCo has increased its dividend for 51 consecutive years, placing it in the elite dividend king category. Despite inflation and supply chain shocks, the company has grown revenue steadily, with snacks and international markets showing exceptional performance. Why it matters. PepsiCo owns products that consumers buy regardless of the economy. That's called inelastic demand, and it's a superpower for dividend safety. It's also investing heavily in sustainability, digital supply chains, and healthier product lines, aligning with long-term trends. Its pricing power and logistics scale allow it to pass costs to consumers without hurting sales, a rare trait in a high-interest rate environment. Analyst sentiment. Wall Street is bullish. Citi, J.P. Morgan, and Wells Fargo rated buy, citing predictable earnings, strong dividend coverage, and international growth potential. Final verdict. PepsiCo is the kind of stock you hold forever. It offers steady income, strong capital preservation, and just enough growth to outpace inflation. If you want low volatility wealth that compounds over decades, Pep belongs in your company introduction. If you want to build wealth quietly and consistently, Brookfield Infrastructure Partners, BIP, is your go-to long-term asset. This Canadian-American infrastructure giant owns and operates mission-critical assets, from energy pipelines and telecom towers to toll roads and data centers across more than 30 countries. Market cap, $15.29 billion. Current stock price, $33.11. Dividend yield, 5.2%. 3-year dividend yield average, 4.9%. 3-year price growth, decreased by 16.13%. BIP's dividend is where the magic lies. With a 5% plus yield and a 13-year track record of annual dividend growth, it's a favorite for income-focused investors who want stability with global diversification. The company pays quarterly dividends and has grown its payout at around 6 to 9% annually, well supported by predictable cash flows. What separates BIP from utilities or REITs is its exposure to infrastructure megatrends like digital connectivity, decarbonization, and global urbanization. Its recent expansions into data centers and renewables make it future-ready, while core businesses like midstream energy and transport provide cash flow reliability. The company follows a smart acquisition model, buying undervalued assets and improving efficiency to drive cash flows higher. Even during periods of high interest rates, Brookfield has managed to protect margins by passing costs through inflation-linked contracts. Analyst sentiment. Firms like Morningstar and RBC Capital rank BIP as undervalued with a long runway for dividend and NAV growth. It's considered one of the most durable infrastructure stocks in the market. Final verdict. BIP gives you the best of both worlds. High dividend income and exposure to infrastructure tailwinds without the volatility of cyclical sectors. For investors looking to own global cash-flowing assets, this is a core holding to never sell. And the last stock is Realty Income Corporation. Company introduction. Nicknamed the monthly dividend company, Realty Income, is a dream for passive income investors. With over 55 years of stable cash flows, This REIT owns 13,000 plus commercial properties across the U.S. and Europe, mostly leased to blue-chip tenants like Walgreens, FedEx, and 7-Eleven. Market cap, $51.13 billion. Current stock price, $56.62. Dividend yield, 5.61% paid monthly. 3-year dividend yield average, 5.3%. 3-year price growth, minus 18.42%. Realty Income's business model is based on long-term net leases, meaning tenants cover taxes, insurance, and maintenance. This makes O's cash flow extremely predictable and resilient, even in economic downturns. Its tenants are recession-resistant: pharmacies, grocery stores, and convenience outlets. Realty Income also maintains a 95% plus occupancy rate and boasts dividend growth for 30-plus years, with 640-plus consecutive monthly dividend payments. Realty has been expanding in Europe and industrial assets, balancing retail exposure with high-demand sectors. Even with interest rate volatility, Realty Income uses fixed debt and conservative payout ratios to maintain dividend safety. Analyst sentiment. Analysts from Bank of America and Raymond James rate OA buy, citing its strong balance sheet, consistent earnings, and rare monthly dividend schedule, making it perfect for retirees or cash flow investors. Final verdict. Realty Income isn't flashy, but it's incredibly reliable. It pays monthly, grows its dividend, and owns real estate that people rely on every day. If you're building a passive income stream that can weather recessions and inflation, Realty Income deserves a permanent spot in your portfolio. Conclusion. So, let's recap the 5 powerful U.S. stocks we just explored. 1. Johnson & Johnson, a healthcare king with safe dividends and pricing power. 2. Microsoft, tech giant with AI momentum and fast-growing payouts. 3. PepsiCo, consumer staple with 50-plus years of dividend hikes and recession resilience. 4. Brookfield Infrastructure, a 5% yield with global exposure to future infrastructure trends. 5. Realty Income, a monthly paying REIT with reliable tenants and durable income. These aren't just stocks. They're pillars of long-term wealth, built for safety, backed by cash flow, and designed to reward you for decades. If you're serious about building long-term wealth with low-risk, high-quality stocks, this is your playbook. So here's what to do next. Smash that like button if you got value. Subscribe for more high-quality, well-researched stock picks. And drop a comment. Which of these stocks is already in your portfolio, or which one are you adding now? Thanks for watching, and I'll see you in the next video. Signing off.